8 European stocks to buy before a EUROZONE bailout. Look for European companies to have their time in the spotlight in the upcoming times. The European Union just unveiled a $2 trillion stimulus proposal that combines over $800 billion in recovery funds with a $1.2 trillion budget for the next 7 years. With that in mind, it's time for investors to seriously consider these 7 European stocks. Renault. There's more than one reason for investors to be bullish about Renault stock here. Like its American peers, the French automaker was hit hard by the pandemic. As the virus started spreading around the world, shares plunged. But now Renault stock is on the upswing. In just the last month, shares are up 26%, and they have plenty more room to run before they hit pre-pandemic levels. According to MarketWatch's Barbara Kohlmeier, Renault will benefit from country-level funds as well as the potential EU bailout. The French government has already promised to spend billions to help the auto industry, and as an industry giant, the company should rake in much of the cash. Think about it. Car companies like Ford and General Motors are among some of the biggest market victims in the US. No one was driving, and consumer spending dropped at a record pace. But when plants began to reopen and consumers began opting for cars over public transit, we saw those same US names launch an impressive rally. Europe is already considering a surge in driving. One report suggests that some European companies are specifically asking employees not to use public transit as a means to mitigate infection levels. Public transit certainly has loyal followers, but fear is a powerful motivator. There's one more big reason to embrace Renault stock here. It just announced a new cost-cutting alliance strategy with Nissan and Mitsubishi. Each of the 3 businesses will handle a specific area of innovation. Renault's focus is connected car technologies in key markets like Europe, South America, and North Africa. Ryanair. We would be remiss to discuss European stocks without taking a close look at the airlines. Same as US passenger carriers American Airlines and Delta Airlines, European airlines have struggled lately due to the pandemic. That makes perfect sense given that all sorts of lockdowns and fears of flying seriously depress the number of people boarding for takeoff. Rumors have it that Sir Richard Branson's Virgin Atlantic is at risk of filing for bankruptcy. But Ireland-based Ryanair is ready for a big rebound. According to Irish Examiner's Jeff Percival, Ryanair is one of many travel-oriented companies benefiting right now. Shares rallied on news of the proposed bailout, but there's more to the story. Countries including Spain, Italy, Portugal, Greece, and Cyprus are beginning to remove visitor restrictions. Percival wrote last week that beaches could even be open as early July for sun-hungry tourists. So now Ryanair is right back in the race with its peers to attract passengers at competitive fares. Ryanair CEO Michael O'Leary has been critical of Virgin Atlantic and other European airlines, positioning himself and his company in opposition to those clamoring for aid. It's clear the chief executive is confident in his business, and that goes a long way. Shares are up 30% over the last month, and the climb higher isn't stopping here. Lufthansa. Like Irish competitor Ryanair, German airline Lufthansa is also set to receive bailout funds from its home country. Lufthansa stock climbed 8% higher on news anticipating $10 billion in relief money. Now, of course, that's all relative. Lufthansa is an airline, after all, and certainly hasn't been immune to the effects of the novel coronavirus pandemic. In January, over-the-counter shares of the premier airline were trading for almost $20. Given the intensity of the March sell-off and the quicker-than-expected market recovery, that looks like a lot of upside potential. Granted, like with most bailout funds, there are strings attached here. According to Bloomberg's Christopher Jasper and William Wilkes, Lufthansa has agreed to slightly reduce its presence at airports in Frankfurt and Munich. This move will allow smaller competitors more of a fair chance, and earned it some government favor. Plus, if the funding comes through, the German government will become Lufthansa's largest shareholder. That's not necessarily pretty, but it proves Lufthansa will survive the crisis. Germany is in a strong position relative to many of its EU peers, and it's one of the countries leading the charge for the bailout plan. Also like Ryanair, Lufthansa is set to benefit from resurgent travel demand. If consumer behavior in the US is analogous, pent-up demand will make the beaches a hot destination this summer. Just look at all the pictures from Memorial Day weekend for proof. With all this in mind, investors should expect the rally in Lufthansa stock to continue. Banco Santander. Just like US banks, banks in Europe, both inside and outside of the Eurozone, tumbled as the pandemic began to wreak havoc. And just like what we saw with Bank of America and JP Morgan Chase, much of that tumble was unwarranted. So it makes sense bank stocks are some of the European names most likely to rally higher on an EU bailout. Spain's Banco Santander is a particularly strong contender for a rebound play here. Remember how many US experts urged investors to recognize that the pandemic was different than the Great Recession? Well, that same narrative is playing out in Europe. Bank stocks fell across the board, and Barron's Pierre-Brian Kohn says fears of the financial crisis were definitely at work. Although several bank stocks are leading European indices higher, pick up Banco Santander shares first. It's often considered one of the Eurozone's top lenders, which means it has a great reputation. A bank's ability to maintain consumer trust is key factors in its recovery. Reuters' Shruti Shrankar detailed last week how Banco Santander has been on a winning streak, and the rally isn't ending there. Shares are up 12% in the last month, with more upside to come. LVMH. The luxury goods sector has been particularly impacted by the coronavirus outbreak, due to the industry's reliance on Chinese consumers. LVMH shares have dropped 13% since a recent peak of €439 on January 17th. RBC said the company offered the most balanced risk-reward exposure in the global luxury industry. Its product exposure is balanced across a broad range of consumer categories, across distribution models and geographies, which we believe makes it an attractive stock at times of increasing macroeconomic risks. RBC Europe analyst Peral Dadhania said, issuing a 12-month target price of €435. Puma. The German sportswear company issued a sales and profit warning last month as the coronavirus has heavily impacted business in mainland China. Puma's stock was initially unaffected by the warning as it reported record sales of €5.5 billion in 2019, an 18% increase on the previous year. We believe Puma offers the highest earnings growth potential in our broader coverage. Brand momentum remains strong with a clear roadmap for future growth in FY20 and beyond, Dadhania said. Diageo. Guinness parent Diageo warned the epidemic could hit profits by up to £200 million in 2020, and said sales in China have been hit by closures of bars and restaurants so far this year. The stock has fallen 13% since January 17th to 2,833 pence, and RBC said it was time to buy. Diageo is doing pretty much everything right in its pursuit of becoming a reliable compounder of growth in our view. It's executing the whole virtuous circle thing in an exemplary way, steadily upping investment in marketing and seeing the results in sustained revenue growth, declining cost ratios, and higher margins. RBC analyst James Edwards-Jones said. BHP. The mining sector has plummeted 16% since the middle of last month, and RBC predicted worse to come as the market attempts to price in the demand shock through commodity markets. However, analysts said miners were in excellent shape, having gone through a down cycle in 2015. RBC said it favored BHP in the sector, as it had low net debt and its core iron ore, copper, and oil businesses maintained high average EBITDA margins of 40 to 60%. Let us know in the comments which of these stocks will no longer be in your portfolio. Hey, here's a bonus stock we strongly recommend. Lockheed Martin. Lockheed Martin is a company that virtually everyone recognizes. This is the world's largest defense firm by sales, bringing in $44.9 billion in revenue in 2017 from arms sales. LMT stock reflects that lofty position. Prior to March and the coronavirus-fueled market sell-off, the value of LMT shares had increased by 132% over the previous 5 years. The company currently has a market cap of $109.5 billion, even after the coronavirus effect. With China making aggressive moves, Iran coming into conflict with the US in the Gulf, Russia continuing to raise hackles in Europe and the Arctic, and North Korea still testing missiles, the market for Lockheed Martin's weapons and defense systems will continue to be strong in the foreseeable future. Thank you for staying with us. Don't forget to leave us a like, share this video with your friends, and also subscribe to our channel to receive more engaging business content like today's video. Hey, if you enjoyed our video, you just have to watch this one.